Okay, welcome back. This is Eric Mattingly with the Wealth Building Strategy Series, welcoming you to our next topic, the 7 laws to creating wealth. The purpose of these workshops are to teach financial literacy to like-minded individuals and provide a central training location for investors and business owners that are interested in creating wealth. DMI Holdings is a privately held equity investment company which provides investors with a relationship-driven, trustworthy, and profitable partner who implements alternative strategies for growing wealth. We build lifelong relationships with our clients by using a disciplined, research-focused approach with the objective to produce consistent above-market returns for our investors. My name is Eric Mattingly. I'm the CEO and founder of DMI Holdings. I've been an entrepreneur for over 15 years, and I've had an opportunity to travel all around the country and speak and teach investors on investment strategies and concepts we use in our own business to invest in a variety of different projects. Currently, we've been involved in putting together and structuring over $1 billion in investment transactions. We've done a lot of different types of real estate projects, considerable amount of multifamily, business expansion opportunities, private and hard money lending. And so we've had a pretty good, diverse mix of projects, and we've seen the good, the bad, and the ugly, and have learned a lot over the years, and just put this workshop series together to share some of those experiences with all of you. My dad used to always tell me a wise man can learn from the mistakes of others. A fool has to find out on their own. And that's very true. Unfortunately, sometimes, whether you want to learn from others or not, there's things that you have to deal with sometimes to have those valuable lessons for your own life. The concepts I'm going to be talking with you about today, again, are very simple. The majority of these workshops are really designed for anybody at any level to be able to understand, and the simpler it is, the easier it is to be able to use and remember. I started teaching my kids financial literacy when they were very young, and it's unfortunately not taught in schools. We have a workshop where we kind of go into that in a little bit more detail on building financial literacy. The topic today is the 7 laws to creating wealth. Creating wealth is a mindset. I was fascinated with making money, building wealth from a pretty young age for no real rhyme or reason. When I was about 18 years old, I started just really doing a lot of research and trying to find, what was out there to, be able to have a nice life as I got older, and was concerned about, taking care of myself in retirement. Even though it wasn't something that was really taught to me, I just became fascinated by it. And unfortunately, I didn't have a lot of mentors, and there weren't people out there at that time that, other than Tony Robbins, whom I listened to everything that he taught, but there's just more information out there today. And we wanted to take some of those experiences and knowledge, as well as life experiences, and share that with others that are also interested in learning. So really, your mindset is very important. A lot of people think you got to have money to make money, and it's really not the case. Anyone in any circumstance at any income can create personal wealth. A perfect example is most people have heard of Robert Kiyosaki. We follow a lot of his principles, and he has a game called Cashflow. I just played that with my wife and her cousin that came in for our wedding. We recently got married, and I was the janitor, my wife was a doctor, and her cousin was the lawyer. And although they made more money than I did, income-wise, they also had much higher expenses. And so as a janitor, I was actually able to utilize some of their capital to be able to do some bigger deals a little bit earlier on, and I actually got out of the rat race before they did. In fact, I chose not to get out of the rat race. I just retired. I had enough passive income from real estate and other investments that I had accumulated through playing the game to where I was satisfied and didn't actually get out of the rat race and go big time. So it's a misconception to think that, I'm a teacher or I'm, this or that, and there's no way for me to really be able to achieve my financial goals, and that's just not the case. Most financial mistakes we make come from breaking one of the 7 laws to creating wealth. In fact, every mistake I've personally made, this definitely applies. And so these are very simple rules, and unfortunately, sometimes they're very costly if you don't follow them, which has been the case in my case. And so we're going to share those rules with you. So there's 7 laws to creating wealth. The first law is to pay yourself first. What happens is a lot of times people get out there and they're going to pay all of their expenses, and then what's left over, they're going to set it aside and use it for investing or whatever. And this has to do with anybody at any income, for the most part, unless you have significant income. But for most people, whether you're a surgeon that makes $1 million plus a year, or you're in some other kind of occupation where, you make $50,000 a year, you'd be surprised how many people that I've talked to. I've worked with thousands of investors over my career, and some of the things I've seen that people do that have these high incomes that could have just set themselves up for the rest of their lives if they would have just followed some of these basic, simple, fundamental principles. It just amazes me. So this is very important. You don't pay your expenses first. You pay yourself first, and you set that money aside, and you move that money into I have different accounts that I move money into. So when I earn money, I've got a spending account, I've got an operating account, I've got a spending account, I've got a giving account, I've got a travel account. And what it allows me to do is, as I have money come in, as soon as it hits my bank, I divide that money into the various different accounts to be used only for the purpose in which those accounts are there for. So I don't go and rob from my travel account, which traveling to me is a high priority. I view it as an investment. I'm not going to take away from my passion to pay a bill. I will find some other way to do that. So it's important that you make that a habit. As soon as money hits your account, however you earn money, have a separate account and move a percentage, whatever that percentage may be. I always recommend that people take no less than 10% of your income to be saved and set aside for whatever that purpose is. I just shared with you in my case, I have several different special purpose accounts, and I have them divided into percentages of my income that I move into those accounts to be used for those things. But at least 10%. The thing that you will find, and people will go, well, I don't have 10%, including people that make a lot of money because they continue to increase their expenses as they continue to increase their earnings. And I think what you'd find is you're wrong. What happens is you consume your money if it's available to you. So if you did take 10% and swiped it over into another account, you would find that you would still, in most cases, be able to pay all of your bills and have it, and wouldn't really notice it because you just might not stop and make some of those extra impulse purchases or some of the other things that you do if the money's just sitting there, because at the end of the month, you're generally not going to have the money that you're wanting to set aside unless you just have a significant income. If you owe debt, then 10% is still saved, 20% is applied to debt, and 70% goes to expenses. There's a whole nother workshop we do, a wealth building strategies workshop I'll do on debt elimination strategies, but the best thing out there on the market, I'd suggest you get Dave Ramsey's debt elimination snowball. It's probably the most effective way to eliminate your debts, your house being the largest one of those, but you don't have to sacrifice setting money aside to eliminate debt. The other issue is, again, if you wait to the end of the month to start making payments on debt, and then you're waiting to the end of the month to save money, you're going to find that you get to the end of the month and you can't do either one of those things in many cases. And then if you do charitable giving, which I'm very big on as well, and, you know, this is, a lot of people don't understand, you know, if you give of yourself, whether that's money, time, your knowledge, your life will be blessed. You have to give back. And what you'll find is that the more you give, the more you wind up getting. And I can't really explain how that works, other than you've just got to try it to see and feel the experience of that. But giving is important for a lot of people. A lot of people that go to church, they tithe. And whether you go to church and tithe or whether you like to do direct giving, which is what I enjoy doing, you need to set money aside so it's available. So when the opportunity comes in order to give, you're prepared. I can tell you that the times that have been presented to me, they don't always come at the most opportune time. And having money set aside to wait for those things to come up it really makes it easier to be able to manage. But I still don't say no. I find out a way to do it, and it's been very rewarding. Second law is to control your expenses. So a lot of people say, well, I don't have any money left over at the end of the month, and you know, I'm not able to pay myself first. That's because you're breaking law number 2. If you truly do not have anything left over in the month, and all you do is go to work, come home, pay your rent, buy groceries, don't ever eat out, don't go to Starbucks, and there's just nothing left over at the end of the month, then your expenses are too high. You might have the wrong car, you might be in the wrong house, you might need to share a room with somebody or have a roommate. There's a lot of things you can do to get your expenses down. So don't let your necessary expenses grow with your income. I have seen this occur on a large scale. I had a doctor that was interested in investing with us that made $1 million a year. I'm sorry, he made $600,000 a year. He had I forgot, maybe like a $1 million house, had the thing mortgaged to the hilt. And this guy is 60 years old, 62 years old, and he wanted to retire at 70. Has no investments of any kind. He had about $200,000 in credit card debt. I mean, it was just, the list just went on, and he's sitting down and wanting to get my advice on, you know, how he can retire. And I said, well, the first thing you need to do is your expenses are too high. You make a significant amount of income and you burn through all of it on, I don't know what. Why do you have any credit card debt of any kind when you're making $600,000 a year? And come to find out, you know, and this is another thing that's important, you know, his wife was a big spender. So yes, he did make a lot of money, and yes, their overhead was high. And if his wife wasn't going out buying Louboutin red bottom shoes and purses and all these other things, she was basically consuming their investment capital. If he had been setting money aside every time he had a deposit come in into an account, ideally she didn't have access to, so that they could invest for their future, he would have been okay. But to this day, and this is 10 years later, that guy is still working. You need to know what your monthly expenses are. If you don't have a budget and have all your expenses and take into account, you know, entertainment and, you know, your HBO apps and all the other things, you don't know what you're spending. And then you look at your income after your taxes, you look at all your expenditures, and I review my financial statement and my budget and expenses, and I update it regularly, no less than once a month. If you don't know what's going on, you don't know where you're going, and you don't know what you need to do to change things. Some people just sit there and get frustrated, and they complain about, you know, how things are going financially, and they haven't actually sat down, taken the time to analyze what's going on in their life as it is, where their money is going, what their expenditures are, and if they're married, maybe one person knows about it and the other one doesn't. You've got to be on the same page to be able to manage keeping your expenses down. You hear the expression, keeping up with the Joneses. You start out making $50,000 a year, and you live you live around that income, and then your income goes up to $100,000 a year. Oh, hey, we need a bigger house. Oh, I need a new car. When the car you had was working just fine, you only had it for 3 years, and it gets good gas mileage, and you know the story, and that just continues to happen, and it can consume all of your capital. What you should do is keep your expenses down as your earnings go up, set more of your money aside, invest, have the income from your earnings from your investments fund your lifestyle, not your blood, sweat, and tears working at a job or your business, because then you can never actually be financially free and you're a slave to your money. You need to review your financial statement regularly. I suggest no less than once a month. But a lot of people at a bare minimum quarterly, but I can tell you, if you're not in the habit of doing it and you don't know what your income, your expenses, your assets, and your liabilities are, you get in the habit of doing that and you update it regularly. And your goal is to have as many sources of income in your income column as possible. If the only income you have is from your job or your business, you're in trouble, because if something happens to that one source of income, you're out of business. Get in the habit of controlling your finances. How you get in the habit is you review your financial statement regularly, and you got to know what your monthly expenses are, and you need to make sure that your necessary expenses don't grow as your income does. And again, if you're married, you sit down and review that with your spouse so you're both on the same page, and you're able to kind of help have some checks and balances with what's going on financially. Some people are afraid to talk about money to their spouse. So if you're married, you should both be on the same page with your expenses. If one person is a saver and the other one is a spender, and you're not able to resolve that, and you didn't talk about those kinds of things before you got married, a lot of times what happens is that ends in divorce. Financial pressures and troubles are one of the leading causes for divorce. The third law is to multiply your money. So now you're setting money aside, you're on the same page with your spouse if you're married, and now you need to actually put your money to work. So you got to give your money a job. It needs to go out there and earn interest and a return. You don't want to be a slave to money. You want your money to be a slave to you. And if you know what you're doing and you put your money to work, it works 24 hours a day, 7 days a week, 365 days a year. So you can't do that with a person, but you can certainly employ your money that way. Then once you give your money a job, your money is going to produce results. And as those results start occurring, you give your money's children a job, which is your earnings that you're making off your money. Then you give your money's children's children a job. That's compounding your earnings, compounding your wealth. You'd be surprised if you are able to consistently get a reasonable return and you can reinvest those earnings back into earning you more money and accumulating more investments that kick off cash flow, as well as be able to appreciate in value. It doesn't take you a really long time to actually get to where you want to go. Saving money alone will not get you to the finish line. There's only a few people that have the kind of earnings that literally don't need to invest their money, and they're going to be taken care of for the rest of their life. I've got a close friend, when I met him years and years ago, he's making $300,000-$400,000 a month, had no debt, lived in a $200,000 house, drove a $15,000 minivan. I mean, he was literally the multimillionaire next door, had $5 million liquid sitting in cash in a checking account, had real estate that he paid for all cash, had no business debt. And when I met him, I said, you have significant earnings, but you have no investments. Why aren't you investing your money? He said, well, I just would rather not lose money. I don't know what to invest in. And I make enough money where I can be taken care of for the rest of my life, even if I never learned. That's just not real common. Most people are not in that position, but it was really interesting to meet a guy like that. Most people that have significant earnings, they spend a significant amount of money as well. The fourth law is to protect your investments from loss. There's a number of ways to do that, but we'll talk about a few. Beware of unusually high returns. So again, I shared this with you in our last series. A lot of people do what I call haphazardly investing. That means that they just see something, looks like a good investment, don't know anything about it. And unfortunately, generally where you make your biggest mistakes is when you don't have a lot of money to play around with because you want to get rich quick. So somebody gives you a hot stock tip or tells you about some, weird investment opportunity that can double your money in 2 months. Generally, what that means is you're going to lose your money in 2 months and you're going to be chasing down and wondering how to get your money back, and you're not going to be able to. So you have to watch out about what you're investing in. And if you don't understand, this is very important. If you do not understand how you can make money and you don't understand the investment, you also do not understand how you can lose money. So don't invest in things that you don't understand. It's okay to say no. Invest in the things that you are comfortable with and that you understand. Remember who won the race. The tortoise and the hare, right? It wasn't the rabbit. So trying to get there quickly sometimes can prolong you getting there at all. I've seen a lot of people squander away. When I was young, I tried out a bunch of different things as well, and none of them worked out. So, you just need to take your time, pay attention to what you're doing, and build wealth slowly. So if the investment sounds too good to be true, in most cases it is, not always. I mean, Amazon at one point was, you could buy it for $1. Google, same thing, right? So if you got lucky, but most people don't have the knowledge to actually know that Amazon was going to turn into Amazon or Google was going to turn into Google. You would be speculating a little bit, and that's okay once you have enough capital to take a small percentage of it and take those kinds of risks, understanding that if you did lose the money, you don't care because it's not going to change your lifestyle, and you do have an opportunity to knock one out of the park. But if you don't and you lose the money, you need to be prepared to not ever see it again. So don't invest in things you don't understand. Just create wealth slow and steady. Take your time, and you'll get there. Law number 5 is to own your home. This also has to do with investing in hard assets. So your personal residence is not an asset. We talked about this in the last workshop. If you paid it off, all cash, you still have property taxes and insurance and the cost to live there. However, by paying off your mortgage, you do not have the debt obligation. You do still have expenses, but it's important that you don't have debts hanging over your head unless it's good debt that helps produce income. Debt on your house does not put money in your pocket. So your house would be the last debt to pay off if you have other debts. Using the debt snowball is the best way to get there. And again, if you have debts and you want to look at how to make them all go away systematically, Dave Ramsey's debt elimination snowball is probably the best method to do that. The renter never owns anything. So you have part of, if you're married and if your home is paid off, and let's say you don't have life insurance and you died, you in a sense are self-insured because your spouse, your surviving spouse, could actually sell the house, take the cash, rent, and have just a rental payment, but have a lump sum of capital that they could then invest, generate income for themselves that would actually cover their rental payment. So it's important that you don't carry debt. And then invest in real estate. There's so many advantages to investing in real estate. There's many different kinds of real estate you can invest in. My personal favorite asset class in real estate is multifamily. We've done, over 20 large multifamily projects over the years. And for a cash flow strategy, tax advantages, being able to pull your capital out of an investment but still own the investment, there's just some really interesting and unique things. we'll talk about in our multifamily investing benefits, wealth building strategies workshops, to give you a little bit more insight into some of the things that you can do. The sixth law is to insure a future home. Disability and untimely death have caught and ruined many families in their finances. It always amazes me that people will insure their car, but they won't insure themselves. You've got auto insurance. Nobody likes to pay insurance until you actually need to file on it and it pays for something for you. Then it's the best money you ever spent. So it's important that you are covered medically as well as your assets are insured. You should personally be insured. Whether you choose to cover your life, there's some things that you would need to look at on if it makes sense to have life insurance or not. I used to have life insurance on myself until I didn't need it any longer, and then I didn't maintain the insurance because my family will be taken care of based on the investment decisions that I've made versus an insurance policy death benefit payout. So it is important that you are insured as well as your assets. And another big thing, and this has to do with just having multiple sources of income, which will be another workshop that we'll cover and go into that in a little bit more detail, is that you need to have investments that produce income. The typical financial advisors will teach you and offer you investments that are volatile, number one, and then hopefully at some point in the future, they're worth more in value. And at that point, they're going to then convert those investments for you when you're ready to retire into income producing investments called annuities, where you're going to be lucky if you get a 4% return on your money. So if you were able to accumulate $1 million and you converted it into annuity, and now you're going to have to downsize your lifestyle because you're going to get $40,000 a year off of $1 million. That's ridiculous. Now, granted, it's guaranteed and all of those things, and that investment is actually insured and is got the G word attached to it, which in fact, insurance is not an investment. It's based on contract law. So it's a guaranteed product that will guarantee you to have income for the rest of your life. The trade-off is the low returns that you're going to get. So by investing in things like real estate and other kinds of investments that can produce income for you, it's insuring you against things like job loss, disability, things like that, where you should be able to not have your business or job and be able to pay for your current lifestyle. If you are not able to do that, you are not financially free. Being financially free, the definition of financial freedom is that income from efforts other than your work will pay for your lifestyle. That doesn't mean you're wealthy. I was the janitor in the game Cashflow. My expenses were $1,500 a month. For me to be financially free, all I needed in passive income was $1,500 a month. It wasn't that hard for me to get there. It was a lot harder for my wife, who's the doctor, and my wife's cousin, who was the lawyer, to be able to cover their expenses with passive income than it was for me, because my expenses were so low. Rule number 2 we talked about earlier. And you want to have income from more than one source. So it's extremely important that you have multiple sources of income. And again, we'll go into some of those things in that workshop when we do it. And then the last law, number 7, is to increase your ability to earn. Whatever it is that you do, be the best at it. You need to really look at other options out there. So if, for example, you have a job, you're kind of an entry level, make a commitment to be the best that you can be at whatever that position is, so that you can move up and get raises and be promoted. And this opens up the door to other potential job opportunities that could offer you better advantages, maybe additional benefits, higher income. Be committed to be the best. Don't do things halfway. If you have a business, people that own businesses, in most cases, they're going to put their blood, sweat, and tears. They don't have a schedule. But whatever your business is, you want that business to be successful, because your business's success is your success. So, do research, look at your competitors, and understand how you can model your business off of other businesses that are achieving what you're looking to do with yours, whatever that business may be. Acquire education, experience, and confidence in yourself, and use these things to improve your income. There's just so many different ways. I had an opportunity of training many investors over the years. We had an education company for quite a while, and a lot of people would always ask, though, what kind of business do I start? There's a lot of different ways to actually do that. For me, I kind of gravitated towards real estate investing as a business that I did. In addition, I was in the martial arts industry. I had a mixed martial arts school, which a lot of my time was actually spent in the evening training people in classes. And during the day, I spent all my time studying and learning how to invest. And then when I found real estate, I focused really heavily on that, because I felt like it was a way for me to not only build wealth, but to also create income from efforts other than my work. And each real estate project that I did would be an additional source of income, and it allowed me to be able to invest when I didn't have any money by working with and being able to put investments and opportunities together for other investors. And then I got to participate in a small scale, but I didn't need credit. I didn't need my own money. So there's a lot of things that you can do to increase your ability to earn. And as I said, starting a business or businesses also gives you some diversification. There's things you can do at home, online businesses. I will tell you, your brain is like a computer. If you ask it a question, it's going to give you an answer. Whatever you focus most intently on, you draw more of into your life. So I'll give you an example. If all I ever talk about and think about is how come my car keeps breaking down, how come I, don't make enough money, and da-da-da-da-da-da-da, guess what? More of that's going to come. If you instead ask yourself questions like, what kind of business should I start? You're not going to get much of an answer. If you say, what kind of business could I start where I could work at home and spend 10 hours a week of my time doing something that can generate an additional $5,000 a month, helping others achieve their goals? And the more specific the question and the more frequently you ask it, you're going to start having ideas pop into your head. You might be asleep and an idea is going to wake you up, and it'll come to you, but it's going to be based on you being as specific as possible. Write it down, ask the questions, and you'll be surprised. You'll come up with all kinds of ideas that would be a good business that is an exact fit. What kind of business can I do where I can be in any part of the world and still be able to service my customers and not spend more than 2 hours a week of my time? And, just giving you some examples. You just got to be specific, and you'll start coming up with ideas. So I always tell people you have to learn how to earn a better return. Take the time. These short little workshops hopefully give you some insight and some guidance, some ideas, some principles that you can apply in your own investing strategies for yourself. And I hope some of these things we've shared with you here today have made sense. Like I said, the mistakes I've made have all come from financial mistakes I've made. I've broken one of these rules. And if you think about some of the financial mistakes you've made, you probably realized you have too. And with that, I wanted to thank everybody for joining us here for our 7 laws to creating wealth. If you're interested in learning a little bit more about DMI Holdings, you want to see all of the different projects we've done, you can go to our website. If you do have questions or are interested in looking at investment opportunities for those that are qualified or accredited investors, just email us at invest@wbs.com. dmi-mgt.com. And we'd love to get an opportunity to talk with you. And thanks again for joining us.